Welcome to the Property Strategy Podcast. You are here with Joey DeGarda and Mr. Steve Palise from Palise Property. Mate, it's an absolute pleasure to have you in the studio. We caught up not that long ago for a bit of a chat, and it was excellent just to shoot the breeze. But I really wanted to get you on this potty because we've got so much interest within the commercial space. And I said, who better to get on than Mr. Commercial Property, Steve Palise. Pleasure to have you.
Thanks for having me on, man. Looking forward to it.
Mate, just before we dive in to kind of what I wanted to get out of the podcast, just want to kind of start, and I know hopefully our guests have heard you on previous podcasts before. Do you mind just giving us a really quick little rundown in terms of who you are, what you do, both kind of personally from an investing standpoint, but also maybe a bit of a chance to kind of say, the business and how things are going there from that end?
Okay, so I've been doing this now for 9 years. Before that was an engineer. Yep. So I used to design medical machines, mine sites and stuff like that. Started off a resi investor, so built up my portfolio to 9 residential properties before I bought my first commercial. And then, I'm an advocate for residential, but then obviously started buying commercial for me and other people, and we're 800 plus commercials under my belt now. So now I'm kind of known as the commercial guy. Same thing as a resi buyer's agent. I just have to do a lot more work and get a good commercial. So just find stuff for good tenants, long leases, tight vacancy rates, versatile premises, and just do all the work for the actual client.
Yeah, nice. And so you kind of mentioned something really good there. And this is why I love chatting with you, because you're not one of those guys that are like, oh, you have to do this and this only, and commercial property is the best and residential property sucks, and or the other way around. People go, you have to only buy resi and don't ever look at any other asset class. That's why I like you, not only the open-mindedness, but you've also kind of walked the walk across both of those different fields there. Talk to us a little bit about your kind of transition from residential to commercial. What sparked that? Why did we do it?
It's funny. So it was a bit of a funny story there. So I wrote the first commercial book in stores. So it was about 6 years ago, released the commercial book.
Give it a shameless plug. Go on.
Commercial Property Investing Explained Simply. Fun enough, but I only did that because there was 1,000 other resi books. It was all there. And I actually just got sick of explaining it to people of like how leases work. So I just wrote a book.
Read this.
And then annoyingly, everyone started just being like, oh, Steve, you're just going to push me into commercial. You're the commercial guy, which you kind of said like jokingly.
Yeah.
So I actually wrote a resi book after that just so I could prove to people.
Just the commercial
because people just like, oh, no, I'm going to talk to this person because you're just going to push me to resi. And I'm like, all right, let's do a resi book. So now I can actually be seen as giving like unbiased advice. And then people go, oh, do you know developments are better? I'm like, they are, but they're also high risk. So then I wrote development books. So like, I want to be known as the guy that gives unbiased advice. However, I know way more than most people with commercial without tooting my own horn because I've got so many runs on the board. What was the next question?
How was the original transition from resi to commercial?
So funny enough, I was working for another buyer's agency, and we're primarily residential. But then we started to get a few kind of high net worth investors, and by this I'm just talking like $1 to $2 million investors kind of there, that wanted commercial. And I was like everyone else. I'm like, oh, these are too high risk. They're going to go vacant, like this thing. And then when I actually started looking, I actually couldn't believe the numbers and actually thought I was missing something. And that meant it was even riskier than I thought, because you'd go buy something, literally, you could buy in Brisbane, a warehouse at a 7.5% net yield 6 or 7 years ago. And interest rates were like 4.5%. So you go buy a couple mil asset and you're literally talking passive income, like 40, 50K.
From day dot.
Yeah. And I was just like, this is going to be a dud. But luckily, and I shouldn't say this, I got to play with other people's money.
First,
So I'd buy those properties, and then like a year later, they're coming back and buying another one. I'm like,
why didn't I do that?
This stack up.
Yeah.
And then like, obviously I think I bought maybe like 30 or 40 for clients, and then bought my first one.
Yep.
And then I just bought a little cafe in Ipswich, which was like freestanding, 10 car spots right next to the train station, giving me 38 grand a year. And it was 440 grand.
From the outset?
From the outset, yep. And then it's also got 10 car spots, which I rent out, and that gives me an extra 7 grand a year.
Separately?
Yep, separately. Because it's like a freestanding site.
Nice.
So I was just like, what the hell am I doing? Like my resi portfolio, I had like, nine resis, and it was about a 50 grand-ish income.
Yep.
It was, it's hard to tell. It got up to like 85, but then interest rates kind of went up. And I was like, I've literally bought like an asset, like one tenth the value, and it's replaced it. And I was like, I'm never buying resi again kind of thing. Yeah. So I then went down and obviously to get buying the commercial after that. But yeah, it's just one of those ones I looked at and I was like, you could buy a medical center, 7% net return for $1 million. And I'm just like, what am I doing here? And then that was the shift.
And so and I always just like asking the question, do we still have that cafe?
Yeah,
still sits in the portfolio?
Still got that.
Yeah, excellent. Have you ever been?
I've been to it a couple of times. It actually changed.
Free coffees?
No, I actually didn't. Funnily enough, that's actually paid itself off. So that's debt free. So I got that 7 years ago. So
is that right? Yep, so that was the time spent there.
So because I haven't used the money because I've still been working.
And you had a period of some low interest rates. So that's
Yeah.
maybe part of
but
it.
then rents have gone up as
Yep.
well. But that's probably worth now 800K.
Is there a rough formula that you can give us, say, in this kind of 6-ish% interest rate environment where, like, with respect to that property paid itself off over the 7-year period?
It was a lot funner for the social media plugs to
Yeah.
say it'll pay itself off in 7 years.
Yep. And now?
In reality, 9 to 12 years.
Still not a bad news story, right?
Yeah, that's right. Yeah.
What's the flip side that you see in the resi space to do that paying itself off?
You need a lot of things to fall your way. So you obviously need like rents to double and all that. With commercial, I'm just doing it with 3% rental increases, but it's generally a 15 to 30 year kind of plan there. And that's the thing, like I worked out, I've got on my website, you can download these. I've done a 10-year commercial plan where you get 4 mil worth of assets and you can get 100K passive income in 10 years.
Yep.
I did the exact same one with resi. Same thing of like capital growth, pull up the equity,
Yep.
buy the next one, which was due on game plans.
Yep.
You can see that. And you literally need a 12 mil portfolio to get the same 100K passive over 15 years.
Yeah.
And that's not even taking into account serviceability and all that type of stuff. So you literally need 3 times the size, and it's an extra 50% time just to get the same
Can we like delve into that? Why? Why is it the case? Why do we have such high? I mean, whenever people think commercial, they just think cash flow. Why is it the case?
Perceived risk is one of them.
Yep.
The other one is because lending is tougher.
Okay.
So you need like minimum 20%,
Yep.
typically 30%. So that's a bigger chunk of cash. So
Yep.
you want a bigger return for putting more skin in the game.
Yep.
Whereas residential, like you get a 90% loan or 100%
Fair
because you pull out
risk,
equity,
yep.
and it costs you $50 a week kind of thing. So it's that bang versus buck. But this is the whole thing, which we probably get into a little bit in the podcast, is when's commercial right? Like what's the negatives of commercial, and making that decision is quite tough.
Yeah, exactly. And we'll kind of delve into that because we kind of see, and this is what we see kind of daily, pretty much daily with respect to clients, is there's this idea around building portfolios starting potentially with a residential base, and then at a certain point in a kind of client's journey in their portfolio, they slowly start to transition towards commercial. Maybe it's not an entire swing in the other direction. Maybe it's a partial liquidation of some assets to help them transition there. In your personal and professional experience, is there a formula in place that we see with respect to that kind of acquisition window? Is there like something that you've personally abide by, or that you've seen part
that kind of balance, right? So that's me personally. That doesn't apply for everyone because I want a full disclosure. I run a successful business.
Correct.
Which means I've got enough income to do all the stuff. So that's kind of on the side. What you alluded to, most people say, oh, you start off in resi, then you go commercial, which if you plotted people's plans on a bell curve, the majority of it in the middle of the bell curve, that is the strategy. And the reason for that is because you get leverage. Like the whole thing with property is a game of leverage.
Yep.
I'd rather them go out and buy 3 residential properties on a 90% loan than 1 commercial on a 70%, because if we get 3 times the asset and it has the same capital growth, which it does, you've got 3 times as much to then buy more residential or that. So there's a game there. Where the ends of the spectrum change though is, let's say, lower income earners that might have a good deposit. So they've got an inheritance or something like that, but they don't have serviceability. So like I've got a lot of clients where, I don't know, so it's like a family member passes away and they get $1 million, but they're struggling financially.
Yep.
They can't, their lending servicing is like 300, 400K. So what, we've got $1 million cash and we're going to go buy like a 500, 600,000, have this cash left over.
Yeah.
But $1 million, we can go get them a 3 mil lease stock commercial. So that's way more powerful for their strategy.
What does that spit off in terms of cash flow, roughly?
6%, 180 grand a year rent.
Right.
So like, and it's net as well. But because if they want to do a 50% deposit, like I did with my personal investing, like that's a 2 mil asset. That'll pay off in 7 years time, and they'll have 140, 150 grand passive income from one. Yeah. Whereas we go buy a little 500K resi, like, cool, you're going to have a 30 grand passive income in 10 years time.
It's not really moving the needle, is
it?
So
even like on the low income earners, that can be the right strategy.
Yep.
Then there's the high income ones where they've got the capital. Why would you buy residential? So a lot of my investors, the high net worth ones, they don't leverage up to 100% anyway. They're risk, like my portfolio's got less than 50% LVR.
Yep.
Other high net worths, they've got the capital. They just don't want to do it from a comfort level. So again, they theoretically have more resi capacity, but that's not right for them because they don't. If your portfolio is under a 70% LVR anyway, you really need to weigh up why you're buying residential because you're not getting more leverage. So why not get the thing that grows the same and has the cash flow?
And gives you the cash flow.
Yeah. Then there's another aspect, which I'm talking, I don't want to talk about this on podcast because we're talking game plans.
Yep.
Business owners as well.
Yeah.
So you guys know who you are. You don't want to declare much income to Mr. Taxman.
See this all the time.
That's right. So you don't have any servicing. So you've got a conundrum. Either pay yourself well enough that the banks will actually lend to you.
More tax.
Yep. Or you can go down the rabbit hole of doing like lease stock and avoid that tax. And there's there's mechanisms where you can lend money to yourself for the deposit. So like Steve Palise, the person, can get a loan from Palise Property to pay his 30% deposit. So as opposed to paying a bank or pulling out that money and paying 40-50% tax, I can just pay back Palise Property at an interest rate, a 2 or 3% interest rate. So it's going the other way. I'm making money from my own investment. So there's creative parts if you're a business owner as well. So and then there's self-managed super fund as well. So to answer your question, residential is a good base for the middle of the bell curve, but you need to assess your personal circumstances.
Yeah, I mean, it's like if you put out some of those more extreme outliers, right? So the inheritance, and if you're just kind of talking to the everyday, I'm just starting my investing portfolio, would your kind of advice still be to go out there and buy that resi asset?
100%. If your borrowing capacity is bigger with residential.
Dictates it, yeah.
So funnily enough, like Game Plans is awesome. We use it. The first question I ask for a novice investor is go talk to a good commercial mortgage broker who does resi as well and say, what's my residential capacity? What's my commercial? Then look if there's a disparity. A first-time investor with 100K is going to, like, you can typically borrow 5 to 10 times your income. So that's going to come back. He's got 100K. He's going to be able to buy a resi between 500 and $1 million bucks kind of thing. Commercial, he's probably going to be able to buy 350. So if one number comes back at 700, that one comes.
What are you going to look at?
Why are we doing that? It also goes the other way as well, weirdly enough. Like some people have no servicing at all, but they've got the capital. But the deposit, as everyone knows, is the hardest thing to get started. Saving up the deposit.
And that's why we would usually see that people would start within that residential space. And similar to your own story, maybe not going as aggressive as selling 7 of 9, but selling part of a residential portfolio. Why? To then help provide that capital to then put down the large deposit on the commercial property.
Yeah, and it's always case by case.
Yeah,
like you just got to look at it. But leverage is your friend. Like I actually don't like property as an asset class. Like I think it's a very boring kind of thing. I love that banks will let me play with big numbers and I make big numbers from it, and it's low risk as well. So like I'm a low risk investor. Like my portfolio is under 50%. Like, the banks will give me 18.5 mil right now if I wanted it. But that scares the hell out of me.
Yeah,
because
not interested in it.
And that's residential, by the way. So I can go get 18.5 mil residential extra on my portfolio. But as you know, that's going to be negatively geared. And then all of a sudden I'm like, shit, I need my business to keep earning X, Y, Z for the next 10 years to be comfortable. There goes the holidays. There goes that.
Yeah.
So it's just looking within and being like, what do I actually want? I got clients that they want the Ferraris. They want to be a billionaire. Cool. We have to take on that risk, but they love it. Like you see them, their eyes light up. They get it. I'm not that. So just assess what you're trying to achieve. What time frame do you want to do it in? And what I just mentioned, what you've got to work with the finance for residential. The first two are easy with game plans. What you're trying to achieve, what time frame. That's exactly what the software's for. Then the mortgage broker will tie in the borrowing capacity to help you make that decision of what the outcome's going to be.
And so if there is like a right time, for example, because I know we kind of alluded to it there, but like I've got an established residential portfolio, for example, when is the right time to transition to commercial property?
When you want the passive income and when you need to do it anyway because your LVR is under 70% and why do it anyway? Like why not get?
Can you just delve into that a little bit more with respect to like with my LVR at say whatever it is 70%?
I'll take a little step sideways a little bit. So like typical ones we get is like a lot of like mum and dad clients that have like a 10-year-old and an 8-year-old and that, and then they start looking at private school and they've got the capital there, they've got the equity in the resi portfolio. They're like, shit, we've got 80 grand a year worth of thing. And they're on good income. They're on like 350 grand, 400 grand combined. But after tax, like that's a big chunk of the thing. So they, even though they've got the capacity to go residential and they probably could, but then they can't send their kids to private school and have the comfort there. So we get a lot of like people like that. They'll come by the commercial because they're progressing their portfolio. Another case scenario is they're capped out with resi servicing completely. They can't even get out equity. They're kind of done. They then come buy commercial in the self-managed super fund. So it's just where they're kind of progressing their portfolio. But like I said, I always like line up those. What are you actually trying to achieve? What time frame? And then match up with the finances. Once you actually put it down, it's pretty simple. Like, there's nothing complicated about property. It's literally numbers. It's yield, returns, what do you think? And then matching up and then making sure the banks will let you get that.
Like you execute on that plan. Is there and I know this is so vague as well, is there like a minimum number of assets that you would consider within a commercial portfolio? Like could you have all of your properties commercial? Would you still consider holding a balance of resi and commercial?
Again, it's going to be case by case for what you're actually trying to achieve. In general, yes, like having some really low risk residential, some commercial ones there. I'm a bit different because I know I can actually buy a lower risk portfolio with
asset.
all commercial
Yeah,
because I know
yeah,
what they're doing.
yeah.
A mum and dad investor who's not using a buyer's agent or an expert, probably not. They're probably best to maybe have like 3-to-1 commercial kind of thing. And
Ratio,
and kind of balance
Yeah.
that. And I've got that ratio based on like obviously the LVR,
Yeah.
so you can kind of match it that way.
What about the and I know you alluded to this a couple of minutes ago. What about and this, I personally hate the rhetoric around it, but there is rhetoric around it. I'm sure you'd agree that this topic exists, but I know you've got strong beliefs against it. My residential property will grow at X and my commercial property will only grow at Y. So for example, let's throw around some numbers. Oh, my resi property will grow at 6.5% capital growth, but my commercial property, I'm only expecting 4%, for example.
So complete misconception. That comes from a few facets. First one is certain types of commercial won't grow the same. So an office space will not grow the same as a house, but neither will an off the plan apartment because they don't have a land component. So the other one they happen in different sinks as well. So when like the resi market was going nuts, commercial because of the delayed leases typically lagged behind. The way I also get around that is I just simply ask people, is commercial more expensive than residential?
Yes, it is, Steve.
And everyone says yes.
Yeah.
It's more expensive.
Yeah.
How can something get more expensive with less capital growth? Like if you plot it over 30 years, do it in game plans.
Yep.
Do one at 6% and one at 3%. And that's the numbers people always go. They go, commercial, resi grows at 6 to 7%. Commercial only grows at 3%. Put it in there and over 30 years, commercial should be way cheaper than
how does commercial? Why is there a $2 million commercial asset?
Funny enough, you actually look at the stats in the last 20 years, they've all grown exactly the same. They all grow between 6 and 7%. Funnily enough, out of all the asset classes, so it looked at industrial and residential in all the capital cities. Sydney industrial is actually the best performer. So it's top of this. So that had around 260% growth, and all the other ones had around 190. In saying that though, that's just because it's had a good run due to tightening. So that'll even out over the next kind of 5 years. But they all have exactly the same. And they have to. If they don't, that's where you get the change in cycles. If resi grows by 50%, then investors go, why am I buying this resi?
I'm going to buy that.
And then commercial goes. So they're out of sync as well. So it's harder to pick the growth cycles with commercial. Resi, you can people will say they can do it for 3-4 months. Run a mile if they say that. 6 to 12 months, you can get a bit of a gauge there. But yeah, exact same capital growth. So misconception. The funny thing is anytime someone says that to me, I go, cool, give me any suburb that you want in Sydney or Melbourne or blah, blah, blah. And they tell me, I go, cool, let's go on CoreLogic. Let's go look at some industrial assets. And you click and you look at sale prices.
The growth rate.
And they've all doubled.
Yeah.
So
you get the same amount of capital growth, and I know we kind of touched on that multiplier in terms of the amount of cash flow. So what like that did we say was a 3x multiplier in terms of cash flow?
General rule of thumb is 3x. So most quality assets between 5 and 6.5% net.
Yep.
If you go like a Sydney now because it's had that extra capital growth, that's a sub 5. That's like a 4.5. But basically, so if you're getting, let's say, a 5% net return, so the lower end of that, you don't have outgoings. The tenant pays council rates, water rates. So it's $1 million asset. It's 50 grand in your bank account. You go buy a residential for $1 million. That's typically 4% gross. That's a good one in a kind of a regional area. Yep. Council rates, water rates, maintenance, all that type of stuff. So that whittles down to somewhere closer to 2. So you're going like 2 to 5%. So that's where the kind of
2.5 to 3 times
2.5 comes from. So that's it. So it's a good buffer to build into it.
That's really, really interesting. So you get the same amount of capital growth, a lot more cash flow. Why isn't everyone doing it? Realistically, would you kind of say it's barriers to entry from a deposit perspective is the main inhibitor?
I'd probably take a step forward before that and say misconceptions is the first one.
Sure.
Of everyone just being like, oh, that's not for me. That's for the ultra high net worth. Like that's the vacancy rates. It's all those myths kind of play a part. Lack of education used to be it as well. Like when I started this like 9 years ago,
there was nothing, right?
No one. Like, the only people that really owned commercial were business owners that would have a warehouse and they bought it themselves and they made enough money and they go, oh, this is really good. I'll buy another one. And they kind of went there. This is also one of the reasons I think commercial is going to be a top performer in the next 5 years.
Yeah.
So I've sold 50,000 books and I'm a small fish in a big pond. Other buyers agents have probably sold more than that as well. So there's 4 or 5 other commercial buyers agents. There's 200,000 people with Educate. My podcast has had like 1 million listens now as well. So in a pool that used to be, and I'm making up numbers here, let's say 20,000 Australians who were commercial investors. Now there's hundreds of thousands are looking. And as you know, with the resi, supply and demand, the demand's
going to push those prices up,
the supply is actually going down as well. So I think that's going to give us capital growth there.
It's obviously going to make your job a hell of a lot harder.
Yeah.
In terms of trying to find good assets.
In regards to the amount of sales as well. So like there's some stats out there showing that only there's like 4,000 sales per year in commercial as well. So it's really tough. But you touched on the perfect one is barrier to entry as well. Most people don't have a cruisy like 300, 400.
Just
grand,
lazy laying
but they
around.
can pull out 100K from their resi portfolio and kind of go from there.
Which people don't really think about, right? Like you might not have the 300-400 grand sitting in the bank account, but lots of people do have the 1.5, $2 million home with a $400,000 mortgage against it.
That's the biggest one, and to be honest, that's the scariest for most of our clients because they can do it, and if the cards fall right, they will have the best outcome in the world. But putting up your own home against a high risk asset, and it is a high risk asset because there's more skin in the game, and like if you don't know what you're doing, you'll burn yourself. That's the hardest one.
How does it work for that individual, right? So I've got my home, I'm using that as collateral, and I'm doing an equity release to front a 30% deposit perhaps?
Actually, let's touch on that. So this is why you need to talk to a commercial mortgage broker as well, because let's say you've got a $2 million house and there's, I don't know, 400 grand debt remain not. You might not have the servicing to actually be able to pull out and leverage that deposit. So you go to a resi mortgage broker.
They'll say there's no finance here, Steve.
They'll say you can't get any finance here. A commercial broker will be like, hey, I can actually get 350 grand out of that. But the resi broker, because he can't leverage it, he knows you're not going to go buy a 350 grand asset that way. But if the commercial guy can get it out, he can then get like a lease stock loan or buy something that way. And all of a sudden we're buying $1 million asset. And this is what we mentioned before when you talk, and if there's a disparity, and that's where people will keep moving forward.
That's really, really huge. That's some really, really good advice because we see people like countless times and they'll come in and say, well, I've got no more servicing. Yes, I've got all this equity against my PPOR, against some of my investments, but there's no additional servicing. Your advice there would be go and chat to a really good commercial broker.
Yeah. You don't have to do it, but at least chat with them. Because there are, and we'll touch on this, like the lease stock loans versus full doc loans. There are some other options there as well.
Well, that's exactly what I wanted to dive into next. The differences there, because people throw out this whole, I can just go and get a lease doc loan. Like, what are the differences there between a full doc, a lease doc? Is there anything else that we can kind of throw in? Is there like somewhere in between, for example?
Yep. So full doc, same as resi. They look at all your personal circumstances, your liabilities, your expenses. Yep. They do the shading. They add on the extra interest rate of 1.25 to 1.75%, etc., etc. Same thing with commercial, but you get more income. So it looks a little bit favorably, but doesn't change the dial too much. But this thing called lease stock loan. So that's a loan based on the strength of the lease. So you go buy a 5-year leased property, they'll give you a 5-year loan.
If it's tenanted, no good?
No,
Sorry, if it's vacant, no good?
No. So that you'll need a full doc loan, so you can't get a lease stock loan.
Let's go back to it's tenanted.
We'll touch on the vacant one first, because it's actually an interesting point, because there are some good bargains you can get with a vacant property.
Right.
However, you don't have the servicing, so they're not taking into account the rent. So you need servicing for the whole asset.
Wait.
Without
even though we know market rent is X?
Yeah. So they'll look at that. However, you got to remember, like when you're buying a $1 million resi and you're getting a 2% net, like
it's not that much, is it?
That 20 grand a year, like it's not changing.
It's your income that's the servicing, not the rent.
What kills you? So for that, you might need a bigger deposit. Yeah. So you need like a 30 to 50% deposit. So $1 million, that's a big chunk of change. You're talking 400, 500 grand. What other gets people is you need 10% GST to buy it as well. Yes. You'll get that GST back though on your first BAS statement or however you structure it. You'll get that back. So you're talking like 50% to get into this asset. So that's wiped out unless you're really cashed up with like business inheritance or something like that. We've done the whole net worth guys where we buy stuff below 20% below market value, put a tenant in there, then we go refinance the property back. So they're doing the gamble of putting the skin in the game, but they do it, and it's just rinse and repeat. Yeah. So you basically buy infinitely with that strategy. Getting harder now because owner-occupied properties are in more demand than tenanted ones. Used to be the opposite. That's another side story we'll go on. But where we're going for that, for the lease stock ones, if it is tenanted, they'll give you a loan for the length of the lease, and then based on the yield that you get will be the deposit. The negative is you need minimum 30% at a 6% net yield.
Can I find another lender? Like, would any lenders push beyond that?
There's a couple that's popping up now that you can get, but not for lease doc, for full doc. So you can get 80% full doc.
Yep.
So same as residential.
Yep.
You can't get 90, 100%, obviously. Okay. The deposit can come from 100% loan, but the standalone commercial, you need the one. But that's the bottleneck with lease doc. The favorable part on it is you've effectively got infinite borrowing capacity. So you can, like, because you buy into, say, a trust, that's a profit generating because from day dot,
will be positively
geared. Banks will not even look at that asset and you go again. So theoretically, I can just keep buying commercial properties under lease doc where it's not actually logical. is who can come up with a 30-35%
Every
deposit
time.
infinitely.
Yeah,
And that's the hardest part, and that's where people stop.
Yeah. Yeah, right. Okay. So we kind of mentioned in and sparked my interest there. You mentioned that the owner-occ space is a little bit more harder to get into at the moment. I thought it would have been, tenanted property, everyone wants to jump in towards that.
So 5 years ago, vacancy rates for industrial were say 5 to 7%. I knew what I was doing, so I could kind of buy in the pockets that had like 3-4%.
Yep.
Which was strong, because you remember back in the days, people used to say sub 2% was a type vacancy rate for residential.
Yep.
Now it's like you can buy 0.5%
Yep.
if you really want. Commercial, like a 3% vacancy was still really, really tight for me, because I'm like, cool, that's going to be 6 to 7 months vacancy, but I'm getting 3 times. It was actually 4 times the rent back then.
So I'm okay.
That's right. So I'm going to be okay, kind of thing. Where was I going with that?
The difference is that how the demand's shifted in the owner-occ space.
So yeah, tenanted property would generally fetch 15 to 20% more, because the vacancy rates were higher, perceived risk was higher. So if you had a property, as soon as you got it tenanted, that was the best time to sell, because lending was there as well. Now that the vacancy rates are really shot down, there's some areas of Sydney, North Sydney, for instance, warehousing, industrial, 0% vacancy rate. And the reason for that is because the e-distribution and all that type of stuff, the owner-occupiers want to buy more than the actual investors. So now if you lose your tenant, your selling agent's like, now's the time to sell. So you get an extra 10-15% that way. We used to buy so much in like Gold Coast and like anywhere up the coast, like Burleigh Heads and areas like that. We haven't bought there in 3-4 months.
Why? Just because it's just so
well, you can't get it
hot with owner-occs.
Because why would you sell and lose 15% when you could just wait for your tenant's lease to finish and then it's also, funny enough, we're still actively buying there. Like, is this harder to get a good yield? Like, you were typically buying like 5%, whereas you used to buy like 6%. But if so many of the owner occupiers want that property more than the investors, that's a really good sign the economy is thriving there, because the businesses are thriving. They're making enough money that they actually buy there, which is a really good indicator for capital growth for resi and capital growth as well. So if you can get into those markets, like happy days. We've had clients we bought there 5 years ago, because we run a valuation on it. I've got 3 values in my team, and say, hey, this worth now. And the stuff we're buying for 600K is now worth 1.2. We're like, hey, the yields are coming down. They've been let's sell and move into a better asset. So now all of a sudden, instead of 1.2, now they're buying a 3 mil shopping centre or industrial complex. So we're stepping up that way as well.
Wow. And so they say commercial properties don't grow.
Yeah.
The fact that you've got owner occupiers, and I've even heard you say in another podcast, in some locations, you've got owner occupiers on a waiting list, ready to go.
Where I live in Brookvale, Northern Beaches, if you've got a slightly bigger premise, there's a waiting list of 10, 15 people. Buyers.
And tenants?
And tenants. I was referring to tenants that want to move in just because there's stuff all stock. But again, people don't know how to assess this data because it's all anecdotal. You have to like talk to property managers and find out like who's on their books. What are they waiting for. You can't just go on like SQM research, being like vacancy rate of 550 square meter warehouse.
GPT.
Yeah, so there's more grunt work in it. But when you know the markets within markets, that's where the opportunity lies.
So I was going to ask there a little bit about the due diligence side of things, because obviously with respect to residential property, you could be scrolling and you could probably get a bit of an idea around locations there. But the type of effort that would be required from your end, I imagine, is going to be far greater, because you do buy property for residential investors as well, right? But that grunt work and that upfront effort in terms of the due diligence, I imagine, is infinitely harder.
So resi, you can do a lot of your upfront research upfront, and then you know your area, and then your actual due diligence is quite minor, because once you find the property, you've just got to go through your checklist of like check overlays, check zoning, check easements, check like flood zones, blah blah, check the building and press report. You kind of got your little 5-10 steps. Commercial, you got the same thing, but you don't get to do the upfront work of your location, because you might not find a property in that location.
Right.
So you find it's more reactive. Like you'll find the property. You can maybe narrow it down to like a region, like I'm gonna focus on Perth warehouses
or Southeast Queensland,
or whatever. And then you find that, but it'll take you longer as well, because there's less transactions. So it's not like I've chose Eagleby as my suburb. I'm going to focus on Southeast Queensland, Eagleby. One will come up in the next month or two. Whereas commercial, it's a longer look time. Then when you find it, then you have to do that up front as well. And that actually takes probably similar time as the resi. It's about 4 or 5 hours. But you got to do it every time you find a property. So you find you get like this fatigue of doing it for so long. Then you go under contract subject to due diligence. That's where the real work starts. And you were kind of shocked when I told you before, like 20 to 30 hours, because you got to do lease review, contract review, tenant interviews, road and traffic analysis, vacancy study, occupancy study, check leases are registered, talk to a town planner, talk to property managers. Like you interview the tenant and you transcribe it, you interview the neighbors, then you got to look at what infrastructure is going in. Like we give an 80-page report on that thing. You don't have to do that, but there's a 1 in 5 chance you're going to burn yourself massively.
Yeah.
And so much, like we crush 1 in 7 of our deals.
During that DD period?
During that DD
Wow.
period. It used to be 1 in 5. The reason it's 1 in 7 now is the agents don't bother giving it to us because they know.
Your criteria.
They know what
He's
going to
pull us apart here.
So like a novice investor, they'll still do it in the hope that they don't pick it up. But now, so we've got that down to kind of like 1 in 7
What's that period usually look like? Like for in a resi space, like in New South Wales, for example, you get that 5-day cooling off period.
So you don't do the cooling off. You'll get subject to finance and subject to due diligence.
Yep.
Normally 14 to 21 days is kind of what we get.
Okay.
It takes us, like I said, 3 to 4 days usually.
Yep.
The bottleneck's not that though, it's getting the information off the agents.
Yeah.
So like we've got to harass them like, oh, where's the fire certificate? And then that'll take like a week.
Some time.
Where's the asbestos report? And it's just like all those little nitty gritty kind of things.
Interviewing tenants, interviewing neighbouring tenants. Imagine you did that within the resi space.
Yeah.
Imagine you went and knocked on the door and interviewed the tenant or the guy next door. But I suppose that's the extra layer that you guys go to.
But the success of the business is based on that. There's certain types. So we talk to every tenant as well. But where it's really crucial is if you're doing like a suburban retail, you'll find out all the gold nuggets of like you go by like you interview the hairdresser. They'll tell you what's going on next door.
Yeah, they'll give you
like
the goss.
How their business is doing, who the competitors are. And we've got a list of questions. You can get it in my book as well of like, who's your main threats? And because like, if a competing business comes in, it can screw. And there's even stuff like, say a Woolworths, you got to check town planning. Say like you're going to a little suburban strip and then they're building a Woolworths 1 block away, which sounds fantastic. You're like, oh, a lot of infrastructure going. Yeah, it's all infrastructure going.
Yeah.
But do you think anyone's going to go to your little strip shop and there's a Woolworths shopping centre now? So something like that for resi, if a Woolworths is opening up and you aren't there, you're like jackpot. Like I'm done. Same as a Bunnings and stuff like that.
IKEA.
Yeah, that's right. Yeah. However, there's counter arguments that I really love, and this is a little nugget for your listeners. Go find Bunnings and look at the little industrial properties around it, because normally you've got like a big car park, and then there's normally a few industrials on the outside of those car parks. They always stay tenanted.
Yeah, right.
Because
they're anchored by.
There's always an auxiliary service to Bunnings. So it's like, they'll just be like, I don't know, a nursery or something like that attributes that, and people can get both, or something that complements that.
That's a really good.
Or like a little fabricator or something like that.
Yeah, okay.
And they're always high demand.
That's a really, really good little piece of advice there. But coming back to the overall kind of investment philosophy, the investment strategy, I always like to ask this question. Is there anything that you would have done differently in your personal portfolio? Yeah,
I personally would have changed to commercial as soon as my LVR was less than 70%.
Okay.
And again, I've been a low risk investor. I was a stupidly high risk investor at the start. Like I was buying every property on 100% LVR to the point where the maintenance killed me a few times and I had to ask dad for $5,000.
Can I have some money, please? Yeah.
I used to move back in home so I could get finance to buy another property and then I'd move out again. So
we've all been there, don't worry.
Yeah, so this is probably too personal. Having a big residential portfolio as well, when I went through a divorce, was crippling as well. Because all of a sudden, like you're losing that other income and you're trying to support this, and having neutrally geared assets was a lot harder to build. So if I had a few commercials then offsetting that, would have been happy days, would have been less stressful as well. But because I've always had a lower than 70%. It's only recently in the last couple of years because business has been going well and I've sold the resi that's now lower than 50%. If I'm losing out on the leveraging part of it, what's the benefit? I should have went into commercial a bit sooner.
Okay, so obviously, just transitioning across to commercial a little bit sooner. And then with respect to, say, number of assets in the portfolio, is there like a sweet spot for the everyday investor? I know it's going to be different in terms of the purchase price that they're going to be targeting, but is it like, do you need 10 properties? Do you need 2?
No, so I've stopped. I used to be one of those people who my aim was to get to 10. And it actually burnt me a little bit when I got to 9 and then started selling residential. I never actually
going backwards.
Yeah. But my portfolio was actually growing. Yeah. That's sort of a little regret we need to talk about as well. I was chasing lower priced assets because I was chasing a number. So
as in number of properties?
Number of properties. Right. To the point where like I bought like a townhouse in Foster for 112 grand.
Yep.
Awesome asset. I sold it for 250.
Yeah.
Like it still did its job. Bought a 1-bedroom apartment in Cairns for $30,000. So I bought all these little investments. But my accountant actually gave me the best advice. He's like, as your income started growing and your business started flourishing, you need to stop buying the little 200, 300 grand assets. Even though on paper they look better and actually they can actually perform better as well. But having 10 properties with maintenance issues and that, when an extra 20, 30 grand a year cash flow in reality is not changing my life. If you're making $500,000 plus a year, why are you kind of buying that? So I've been scaling my portfolio value, individual properties as I've got wealthier. And I still see a lot of other buyers agencies. They just want the headline of, I own 100 plus properties. I can't think of anything worse than having $100,000 like B grade. And I don't mean B graders in regards to like, it's a bad asset, but in regards to high maintenance, it's a lower, older property. Like, cool, I will sacrifice that 100 grand difference in cash flow just to have a few nicer properties that I don't have to worry about.
And I think that rhetoric started to change. People starting to see a little bit more value in terms of having fewer properties, less overheads. We always like to say 15 hot water systems, 15 aircon units, 15 screaming tenants that are going to come and complain at you.
And that kills your yield as well. Like, you're better off just buying one good $1 million asset as opposed to three mediocre ones, because it'll kill. It's just ego. And like I said, I don't get angry at people, because I was probably the happiest I was with my portfolio when I was in that first accumulation phase. When you go from like 1 to 3 to 5,
it's the most exciting
you're
part.
like, I'm making it. I'm kind of making it. Then after that, it kind of fizzles a bit into nothing. But people use social media, and I love telling people back in the day when I was like an engineer, I got 6 properties. You've got 6 properties. Funny enough, I was living on the Northern Beaches then. They were impressed by my 6 properties, but they owned a home that was worth more than my portfolio. They had like a $3 million house, and they thought I was more successful than them, but I wasn't. It just sounded cool.
It sounds cool, right?
So now I talk about like just goals in terms of like what portfolio value and what cash flow, i.e. what return do you want? Because who cares? If you got the money to buy a couple good assets, go with that then, as opposed to buying the lower end ones.
I suppose that's a really nice way to round things out, right? It's all about what that end goal is and the end goal in mind. And for most people, the end goal is not to have $24.3 million worth of assets. The end goal is to have $100,000 or $150,000 of passive income that people can then go and have some kind of comfort.
Again, I want to touch on that. So like, I used to kind of say that as well, because you're probably in the world where most people talk to most mum and dad investors. I'm talking to a lot of high net worth investors now. They're not caring about passive income necessarily. They're actually caring about building an empire,
wealth,
and passing intergenerational wealth on. So they actually say, no, this needs to be an intergenerational asset. And that, for me, I'm just going, maybe I'll get there, because my daughter's 2 at the moment and she just wants to play with blocks.
Not quite there yet.
But I can see maybe when they're 20 years old, you start thinking that way. So that'll shift as well. And then other ones, I get mum and dad investors where they literally just want a little nest egg of passive income. If you can get them 30 grand a year, over the moon, that pays for their holidays and fishing and blah, blah, blah. Some of them want to buy like 2 assets, and that's what they're going to give their 2 kids. So it's just literally just try to work out why you're doing this. You won't enjoy it unless the whole fun is setting the why and then trying to get to the why. I can tell you now, my high net worth investors are miserable.
Yes, because they're at the why and it's not as fun anymore, right?
That's right. They've passed the why. They've got enough wealth. So they're setting these targets just for the sake of having a why. So just work out what the why is and then enjoy the bit actually building up to that.
Mate, Steve Palise, absolute pleasure as always.
Thank you so much.
Legend. Mate. We'll get you on next time.
Cheers, man. Thanks, guys.